Short exercise 5-5, sales return early payment. So what we're doing in this transaction is we're going to be journalizing the same transactions for both companies, for both Salem and for Muddy River. All right, so we're going to first journalize the Salem store's transactions. So up here in our summary, it says, suppose MuddyRiver.com sells 2,000 books on account for $19 each. The cost of the books are $22,800. Credit terms are 1/20, net 45. So this means if the company who is buying pays within 20 days, they will save 1%. And so Muddy River is selling to the Salem store. And then later, 100 of these books, which cost $11.40, were damaged in shipment. So MuddyRiver.com later received the damaged goods from the Salem store as a sale return. And then the Salem store paid the balance to Muddy River on October 22nd. All right. So again, we're going to journalize the Salem store's October transactions. Now remember, Salem store is the one who is being sold to. All right, so here we go. October 10th, Salem store purchased 2,000 books on account for $19 each. Cost of the books was $22,800. Credit terms 1/20, net 45. All right, so we now have purchased inventory. So we need to increase our inventory account. And if you're wondering why we're going to debit the account, remember inventory is an asset account and assets increase on the plus side. So this company, Salem store, now has $38,000 of books. How did we get the $38,000? Well, they bought 2,000 books and they cost $19 each. Now we can ignore this cost of these books is $22,800 because the cost is the cost of to the seller. So right now we are recording the purchases, or excuse me, the transactions of the purchaser. So we can ignore this $22,800. All right. It says we bought them on account. So that is accounts payable. And of course, accounts payable is a liability, so that's increasing on the right side. Okay, that was on October 10th. 3 days later, the Salem store, remember that's us, we are journalizing the Salem store's transactions. The Salem store returned 100 books damaged in shipment. So what we're going to do is we're going to reverse this purchase transaction. So AP is going to be going down. AP is a liability, so it's going down. And our inventory is also going to be going down. And it will go down with a credit. Why is it going down? Well, we're returning some books. All right, so how many books did we return? 100 books, and they cost us $19 each, according to this up here. So that's $1,900 return. And then it says the Salem store, again, that's us, paid the balance. So we have to figure out what our balance is. So on a piece of scratch paper, it's a good idea to do a T count for this AP. So I'm going to use Excel. I can't show you scratch paper very well, so I don't want to view the grid lines. So I'm going to make a T account. For AP. The left border, accounts payable. All right, and then just for information purposes, remember the account increases on the right side and decreases on the left side. There we go. Now we have a T account for AP. So what I'm going to do is I'm going to post to my T account. So we had AP $38,000. And then, so that came from right here, 38,000. And then we lowered it by $1,900. So now we need to calculate our balance. Need a bottom border. And our balance, if you wanted to do a formula, is this minus this. So we have a balance in AP of 36,100. So when we pay this off, we need to get rid of this AP balance totally. So we're going to debit it by $36,100. AP is going away. $36,100. Now we need to calculate the discount amount. So if I wanted to use Excel for that, first of all, we had to figure out, well, what was our discount? The credit terms, according to this up here, are 1/20. So if the company pays within 20 days of the original invoice, so here is the original invoice on October 10th. So if we pay within 20 days of that, so by October 30th, we'll get the 1% discount. So we now have the 1% discount because we paid on October 22nd. So let's calculate that. Equals this times 0.01. So we have saved $361. So if we are saving $361, how much are we actually paying? Well, to calculate that, we're going to take 36,100 minus the 361 gives us 35,739. So our cash is going to go down by that amount. Let's see if I can copy and paste that. Wonder if this works. Yeah, cool. All right. So we're paying $35,739 because we saved $361. Now this transaction does not balance. Why does it not balance? Well, that's because we need to lower the cost of inventory by the amount of discount. The amount of the discount was $361. There we go. So you may be wondering why we're lowering the cost of inventory. Well, let's do a T account for the inventory. So I've created another T account. Let's go back up here and post the T account, see what's going on. So we had 38,000, and this was a purchase. And then we go down here, and we see that we lowered inventory by 1,900. And why did we lower it? That was because it was a return. It was a purchase return. So let's figure out what our balance is. You probably already know this, but I'll just do it anyway. Bottom border. So our balance is 38,000 minus the $1,900. So according to our T account, this inventory, let me scroll down here. This inventory, according to our T account, cost $36,100. But did it really cost $36,100 after we got the discount? No. If we look back here, it really costs us $35,739. So how do we adjust this account to go from $36,000 to $35,739? We're going to take the discount amount, $361, put it on the minus side. And now we have the latest balance equals 36,100 minus this. So now that we have subtracted this discount from the inventory account by putting it on the credit side, the actual cost of the inventory is now correct. So that's why when we pay early and we get a discount, we lower the cost of inventory. Okay, now in part 2 of the video, we're going to be doing the transaction for the seller.